Brazil has begun redirecting coffee exports away from the United States following the imposition of a 50% tariff by the Trump administration. As the world's largest coffee producer and America's single biggest supplier, Brazil accounted for roughly one-third of all coffee imported into the U.S. in 2024, more than 8 million bags worth about $2 billion. With the new tariff in effect, Brazilian exporters are shifting shipments toward alternative markets, most notably China, which has just authorized 183 new Brazilian companies to sell directly into its growing coffee sector. The result is a sudden contraction in U.S. access to Brazilian arabica, a cornerstone of the blends used by major roasters and supermarket brands, and a development with significant consequences for pricing, supply stability, and the long-standing trade ties between the two countries. Brazil's coffee industry sits at the heart of a global supply chain that is both massive in scale and highly sensitive to policy shocks. In 2024, the country accounted for roughly 37% of the world's total coffee output, making it not only the largest producer, but also the de facto price setter for both arabica and robusta beans. That dominance extends deeply into the U.S. market, which remains the single largest coffee importer on the planet. About one-third of all coffee entering the United States came from Brazil, and Brazilian arabica in particular is valued for its ability to form the base of blends, offering the body, sweetness, and cost efficiency that roasters depend on to maintain both supermarket affordability and specialty quality standards. China, while still far behind the U.S. in import volumes, is steadily emerging as a significant player in this equation. In the first half of 2025 alone, it imported over 500,000 bags of Brazilian coffee, small in absolute terms, but supported by double-digit annual growth rates and a young urban consumer base driving demand for higher quality products. Chinese investment in Brazilian logistics and trade infrastructure has laid the groundwork for these expanded flows, giving Beijing the ability to rapidly increase its purchases at a moment when U.S. buyers are being priced out. The trade balance underscores the complexity of this shift. As of August 2024, China was Brazil's top export destination overall, taking in 27.4% of all goods, followed by the European Union at 16%, with the United States in third place at just 6.7%. Yet in the coffee sector, the United States has historically dominated. Compounding the tension is the fact that the United States runs a $7.4 billion trade surplus with Brazil, driven by high-value exports such as machinery, aircraft, and chemicals. In this context, the new tariffs are a sharp departure from the mutual dependence that has long defined U.S.-Brazil coffee trade, injecting geopolitical friction into a commodity chain that had previously been anchored by stability, scale, and mutual economic benefit. The tariff measures took effect on August 6, 2025, imposing a 50% duty on a broad range of Brazilian exports to the United States. Coffee, despite being one of the most strategically important commodities in the bilateral trade relationship, was not granted an exemption. This decision came in spite of coordinated lobbying efforts from the U.S. National Coffee Association, the Brazilian Coffee Exporters Council, and other industry groups on both sides of the supply chain, all of which warned that such a steep tariff would have severe commercial consequences. Alongside coffee, the measures also targeted iron, steel, and critical aircraft components, signaling that the policy was aimed not only at agricultural goods, but at sectors tied to Brazil's broader industrial base. For Brazil, the macroeconomic effect is measurable but uneven. Analysts at Goldman Sachs estimate the tariffs will shave around half a percentage point from Brazil's projected 2025 GDP, translating to a loss of roughly $12 to $17 billion in U.S.-bound exports. Within that total, coffee stands out as both a symbol and a casualty of the new trade restrictions. In 2024, Brazil exported approximately $1.9 billion worth of coffee to the United States. Under the new tariff regime, direct losses to the sector could fall between $400 and $800 million, depending on the pace and extent of market diversification. For the U.S. coffee industry, the challenge is immediate and structural. Brazilian arabica beans are integral to the blends used by commercial roasters and specialty coffee producers alike. They are favored not only for their flavor profile, providing balance, body, and sweetness, but also for their reliability of supply and cost efficiency. A 50% increase in import costs effectively erodes these advantages overnight, making it difficult for roasters to maintain both product consistency and price stability. Replacing Brazilian coffee in large-scale blends is not a straightforward task. Alternative origins lack the same combination of volume, quality, and logistical infrastructure, forcing U.S. buyers to either absorb higher costs or substitute with lower-grade beans, potentially altering the taste and quality consumers have come to expect.
On July 30th, China's Customs Authority formally approved 183 new Brazilian coffee exporters to sell directly into its domestic market, an unprecedented expansion of trade access that will remain valid for the next 5 years. Industry officials in Brazil note that such authorizations are normally granted in small increments, 20 or 30 companies at a time, making the sudden approval of nearly 200 exporters both strategically significant and symbolically timed. The announcement came just days before the United States implemented its 50% tariff on Brazilian coffee, positioning China to absorb at least part of the volume now priced out of the American market. This move builds on a broader framework of cooperation established in late 2024, when Brazil's export promotion agency Apex Brazil signed a $2.5 billion supply contract with Luckin Coffee, China's largest coffee retailer. Under that agreement, Brazil will provide 240,000 metric tons of green coffee between 2025 and 2029, supplementing an earlier deal with $500 million for 120,000 metric tons signed the previous year.
While China's current coffee consumption remains far below that of the United States, averaging just 16 cups per person annually compared to more than 400 in the U.S., the rate of growth is accelerating, having doubled in only 5 years. The expansion is driven largely by young urban professionals in major cities, where coffee is increasingly positioned as a premium lifestyle product alongside a traditional tea culture. This consumer shift has been supported by policy measures designed to diversify China's coffee imports, including recent tariff reductions for a number of African coffee-producing countries. Beyond demand growth, China's ability to quickly scale its purchases from Brazil is underpinned by physical and financial infrastructure. Investments linked to the Belt and Road Initiative have improved port facilities, rail links, and warehousing capacity in Brazil, making it easier to redirect shipments away from the United States. These logistical upgrades, coupled with long-term supply agreements, give Chinese buyers the leverage to secure consistent volumes at competitive prices, further integrating Brazilian coffee into Asia's expanding consumer markets. The systemic consequences of this tariff decision extend well beyond the immediate trade in green coffee beans. In the United States, the most direct and visible impact will be a sharp increase in import costs for Brazilian arabica, which will inevitably filter down to retail pricing. For decades, Brazilian coffee has formed the backbone of both mass market and specialty blends, valued for its unique balance of flavor, consistency, and cost efficiency. With the tariff in place, these advantages evaporate overnight, forcing roasters to choose between raising prices, absorbing narrower profit margins, or reformulating blends with cheaper origins. In practice, this could mean an increased reliance on Robusta beans or lower-grade arabicas from alternative suppliers such as Ethiopia, Honduras, or Vietnam. While these substitutes can partially fill the gap in volume, they lack the exact sensory profile of Brazilian beans, meaning many blends will shift in taste and quality, an adjustment that both specialty consumers and mass-market drinkers will notice. The search for alternative sources will not be without complications. A sudden spike in demand for coffee from non-Brazilian origins is likely to drive up their export prices, creating inflated differentials and supply bottlenecks in producing countries that were not prepared to service such large new orders. This dynamic risks destabilizing the broader coffee market, where Brazil has long played the role of a price anchor on the intercontinental exchange futures market. If Brazilian volumes are redirected away from the U.S., the price benchmarks set in New York could diverge sharply from the realities of physical supply in different regions, introducing volatility into a market that depends on stability for long-term contracts and risk management.
The downstream effects on U.S. industries dependent on coffee are significant. According to the National Coffee Association, the coffee sector supports approximately 2.2 million American jobs and generates an estimated $343 billion in economic activity, equivalent to around 1.2% of U.S. GDP. This encompasses not only roasters and importers, but also retail chains, independent cafes, equipment manufacturers, and a wide range of service providers. Even marginal cost increases at the wholesale level can ripple outward, squeezing margins in highly competitive retail segments. Starbucks, for example, is projected by analysts to face a 3.5% increase in annual costs from the tariff, translating to an estimated reduction of 2 cents per share in earnings. Specialty roasters operating on tighter margins may see profitability fall sharply, while supermarket brands, under pressure to maintain competitive pricing, may be forced to downgrade bean quality or increase the proportion of Robusta in their products to offset higher costs. For Brazil, the tariff shock is accelerating an export strategy that was already in motion: diversification away from traditional Western markets towards Asia, the Middle East, and Europe. Brazilian exporters are increasingly emphasizing traceability, sustainability certifications, and higher quality microlots aimed at premium markets less sensitive to price competition. Government-backed export credit lines are helping producers weather the transition period, while major cooperative and private exporters are actively signing long-term supply agreements with key Asian buyers, such as China's Luckin Coffee and Indonesia's Kapal Api. This not only reduces Brazil's reliance on U.S. demand, but also positions it to benefit from the rapid expansion of coffee consumption in emerging markets, where per capita consumption is low but rising quickly. On the geopolitical front, the tariff decision deepens Brazil's economic alignment with China and strengthens intra-BRICS trade flows. Brazil's willingness to redirect its exports to a fellow BRICS member underscores a broader rebalancing of trade relations, particularly in strategic commodities like coffee, soy, and beef. The United States, meanwhile, risks ceding agricultural influence in Latin America, where it has historically been a dominant partner. As China's role in financing infrastructure and providing stable market access grows, it gains leverage not only over commodity flows, but over the political goodwill of key suppliers in the region. In this way, what began as a bilateral trade dispute over coffee becomes part of a larger shift in the architecture of global trade, where traditional dependencies are redefined and market leadership is contested on both economic and strategic fronts. The institutional response to the tariff announcement has been swift, but fragmented, reflecting the different stakes for each party involved. In Brazil, SECAFE, the National Coffee Exporters Council, has been working closely with the Ministry of Agriculture to open direct channels with Washington, seeking selective relief or exemptions for coffee within the broader tariff framework. They have emphasized the mutual dependence between producers and roasters, framing the trade as not a one-way flow of goods, but as part of an integrated value chain that sustains employment and revenue in both countries. The International Coffee Organization has refrained from formal comment, but it is quietly monitoring the situation, aware that any prolonged disruption to Brazil-U.S. flows could reverberate through global pricing structures. In the United States, the National Coffee Association has joined forces with major industry players to lobby for a rollback of the tariff, warning lawmakers that the cost increases will hit consumers directly and could lead to reduced consumption, smaller cafe margins, and job losses in a sector that contributes over 1% of national GDP.
Despite these efforts, financial markets have so far treated the development with caution rather than alarm. Coffee futures on the Intercontinental Exchange have remained relatively stable in the immediate aftermath of the tariff implementation, reflecting a belief among some traders that the measure may be temporary or politically reversible. This muted reaction also suggests that much of the risk had been priced in following earlier tariff threats earlier in the year. However, at the operational level, uncertainty is shaping purchasing behavior. Many U.S. roasters are now sourcing on a hand-to-mouth basis, buying smaller volumes on shorter contracts rather than locking in long-term supply agreements at elevated prices. This approach allows them to adapt quickly if tariffs are reduced or removed, but leaves them more exposed to sudden price spikes or logistical disruptions. Globally, the price environment has created an unusual split. Arabica futures have fallen by around 30% year-to-date, making coffee cheaper for buyers in Europe, Asia, and the Middle East, but more expensive for U.S. importers once the Brazilian tariff is factored in. For non-U.S. markets, the redirection of Brazilian supply could create opportunities to secure high-quality beans at competitive prices, while U.S. roasters face a tightening supply landscape and a higher cost base, eroding their competitive position in the global coffee trade. Looking ahead, the trajectory of this dispute hinges on three plausible scenarios. If the tariffs persist over the medium to long term, the U.S. will face sustained coffee price inflation with structural consequences for consumer habits and the business models of roasters and retailers. Brazil, meanwhile, would deepen its export integration with China, Asia, and other non-Western markets, fundamentally reshaping global coffee flows and reducing the centrality of the U.S. in the trade. In a more moderate scenario where tariffs are rolled back within months, perhaps due to political recalibration or successful negotiation, the U.S.-Brazil coffee trade could normalize, though China would likely retain some of its expanded share of Brazilian exports due to investments already made in supply chain infrastructure.
A third, more confrontational possibility is that the dispute escalates beyond coffee, with Brazil imposing retaliatory tariffs on U.S. industrial exports, such as aircraft or chemicals, widening the rift and feeding into broader tensions between BRICS nations and Washington. Whichever path emerges, the current moment marks a turning point. The imposition of a 50% tariff on Brazilian coffee has disrupted one of the most stable and strategically important commodity relationships in the global economy. It has accelerated Brazil's pivot toward alternative markets, given China an opening to entrench itself as a major buyer, and force U.S. roasters to confront the vulnerabilities in a supply chain they have long taken for granted. For consumers, the implications are tangible. Coffee will become more expensive, blends may change in flavor, and the market itself will become more volatile. For policymakers, the lesson is clear. In an interconnected world, trade measures aimed at political leverage can quickly spill over into essential goods, reshaping industries and alliances in ways that may be far harder to reverse than they are to impose. And as this story continues to unfold, it is not only the price of a cup of coffee that is at stake, but the balance of influence in one of the most valuable agricultural trades on the planet.